Choosing between total capital appreciation and immediate high-yield cash flow is the ultimate structural dilemma facing retail investors in 2026. If you allocate 100% of your capital into traditional broad market equity tracking systems like the Vanguard S&P 500 ETF VOO, you capture exceptional multi-year compounding growth but operate with a severe immediate income deficit, as the index yields less than 2%. Conversely, if you dump your entire net worth into institutional option overlay vehicles like the JPMorgan Equity Premium Income ETF JEPI, you secure massive monthly distributions exceeding 8 to 10%. But you completely freeze your long-term capital expansion due to the underlying covered call strike limits. This is the growth versus yield paradox. Retail capital gets trapped continuously shifting between these two extremes, paying massive transaction friction fees and triggering unnecessary capital gains tax liabilities along the way. In a volatile macro environment, running an unbalanced portfolio leaves you exposed. A pure growth framework leaves you cash poor during a market correction, forcing you to liquidate shares at historical lows just to secure liquidity. On the other hand, a pure high-yield covered call allocation falls victim to inflation over a 10-year horizon because the principal capital lacks the mechanical leverage to expand alongside corporate earnings. To survive and dominate this economic cycle, institutional asset managers deploy a dual-engine architecture known as the hybrid income strategy. By mathematically merging the underlying equity architecture of VOO with the high-frequency income capture of JEPI, we eliminate the friction entirely. We are talking about establishing a self-sustaining financial machine that expanding your principal footprint while distributing high-velocity monthly payouts. Let's audit the internal mechanics of this hybrid framework. The core failure of traditional diversification models is asset overlapping and correlation decay. When you buy random dividend mutual funds alongside growth tech funds, you inadvertently double your exposure to the exact same underlying mega-cap stocks without generating a distinct yield premium. The hybrid income strategy solves this structural flaw by creating a clean, binary mechanical system split exactly 50-50 between pure equity growth and strategic volatility harvesting. VOO serves as our primary capital engine, holding 500 of the largest, most profitable United States corporations. This asset class captures the raw, long-term corporate earnings expansion, compounding fractional share value through secular bull cycles. Simultaneously, the other 50% of the capital is anchored into JEPI. JEPI does not operate like a standard equity fund. It buys a defensive, low-beta subset of S&P 500 stocks and layers equity-linked notes, or ELNS, directly over the portfolio. These institutional notes sell out-of-the-money call options on the index daily, converting stock market volatility into immediate, liquid premium cash. When the market surges aggressively, VOO captures the unlimited upward breakout momentum, offsetting the natural capital caps engineered inside JEPI. When the market enters a violent correction or horizontal consolidation phase, the capital expansion of VOO drops, but the implied volatility grid spikes violently. This volatility spike inflates the covered call option premiums inside JEPI, causing your monthly dividend distributions to scale upward precisely when your growth assets are contracting. The two funds operate in a state of perfect counterbalancing synergy, stabilizing your total net asset value while keeping your cash flow generation running at maximum capacity. Let's analyze the exact institutional data points and risk parameters of this combination. When executing a 50-50 hybrid allocation, your blended expense ratio sets at a highly competitive point, far below any actively managed hedge fund or retail advisory account. The VOO charges a microscopic 3 basis points, while JEPI operates at 35 basis points, bringing your total blended portfolio operational drag to just 19 basis points. This means over 99% of your compounding energy remains inside the asset structure. Furthermore, the blended distribution yield of this hybrid model hovers consistently between 5 and 6%, depending on the macro VIX levels. This is 3 to 4 times higher than the standard S&P 500 yield, providing deep cash flow comfort without exposing your principal to structural decay. The primary risk profile you must calculate is the tracking error relative to a pure benchmark index. During a hyper-aggressive technology-driven bull run, this hybrid portfolio will naturally underperform a pure VOO allocation by a minor margin because JEPI's option strategy surrenders upside performance above its written strikes. However, during a sideways, grinding market, or a structural recessionary cycle. This hybrid model systematically outperforms pure equity index tracking funds on a total return basis because the continuous cash inflows provide a massive defensive cushion. You are intentionally trading away speculative, unearned top-tier percentage gains in exchange for ironclad drawdown defense and continuous automated liquidity. It is a calculated institutional compromise designed for absolute wealth preservation. The operational engine of the hybrid strategy reaches maximum efficiency when you implement a hard semi-annual rebalancing mandate. Twice a year, you must audit the capital drift between your growth engine and your income engine. If an aggressive bull market causes VOO to expand to 60% of your total portfolio weight, you systematically liquidate the excess growth premium and rotate that capital directly into JEPI. This simple, mechanical execution forces you to automatically take profits at market highs and immediately convert those unrealized gains into a permanent, higher stream of monthly cash flow. Conversely, if a market crash drops VOO's weight, you utilize the heavy monthly dividend streams generated by JEPI to purchase discounted shares of VOO at historical bottoms, compounding your future growth engine for free. Institutional disclaimer: all fund statistics, tickers, asset models, and performance simulations outlined inside this presentation are strictly engineered for advanced educational and mathematical tracking purposes only. Past performance metrics across broad market equity trusts and institutional options overlay instruments do not guarantee future dividend consistency or principal safety. Covered call mechanisms carry inherent upside limitations during parabolic market expansions, and all asset allocations carry natural market volatility risks. Consult a certified financial representative before executing heavy portfolio shifts. If you are ready to stop sacrificing long-term growth for immediate cash flow and want to build an advanced, dual-engine financial architecture in 2026, drop a comment right now showing your current asset allocation. Click that subscribe button immediately to lock in our next corporate market analysis. Stay disciplined, protect your principal capital, and track the data structures.